Today, we will be talking about how economic factors are important in the stock market and the 8 I mainly focus on throughout my investing journey. So what are macroeconomic? Macroeconomics is the study of the overall economy and the factors that affect it, such as interest rates, inflation, GDP growth, employment, consumer spending, trade, commodity prices, and government policies. It focuses on how these big picture forces influence economic growth, business activity, people's spending habits, and ultimately the stock market. In simple terms, macroeconomics helps us understand whether the economy is getting stronger or weaker. So, how is it like when the economy is good? Michael has a stable job and receives a salary increase. With more income, he feels confident spending on groceries, dining, and shopping. Businesses across the country see higher sales and growing demand. As revenues rise, company profits improve and more workers are hired. Investors notice the stronger economy and increasing earnings, leading to greater confidence in the stock market. This is how a healthy economy can support rising stock prices. Now, let's take a look when the economy is bad. Michael loses his job during an economic slowdown. With less income, he cuts back on spending and only buys essentials. As many people do the same, businesses see fewer customers and lower sales. Some companies reduce hiring or close locations to save money. Falling sales lead to lower profits, making investors worried about the future. As confidence weakens, stock prices fall and the market declines. This is how a weak economy can affect everyone. So, what are the macroeconomies factors that will affect the stock market? The economy is influenced by 8 key macroeconomic factors: interest rates, inflation, GDP growth, employment, consumer spending, trade, commodity prices, and government events. Together, they shape business activity, company profits, and investor confidence. When these factors are strong, the economy tends to grow and stock markets often perform well. When they weaken, economic growth slows and markets may face pressure. Understanding them helps investors see the bigger picture. Let's first take a look at the interest rate. Interest rates are the cost of borrowing money and are set by a country's central bank, such as the Federal Reserve. They influence spending, borrowing, saving, and investing throughout the economy. Higher interest rates make loans more expensive and can slow economic growth, while lower rates encourage spending and investment. Because they affect businesses, consumers, and financial markets, interest rates are one of the most important macroeconomic factors. So, what's the effect of interest rate on stock market? Interest rates influence how much people and businesses borrow, spend, and invest. When rates rise, borrowing becomes more expensive. Spending slows, company profits may fall, and stock markets can face pressure. When rates fall, borrowing becomes cheaper. Spending often increases. Businesses earn more, and stock markets may benefit. Because they affect nearly every part of the economy, interest rates are one of the most powerful macroeconomic factors. Next, we look at inflation. Inflation measures how quickly the prices of goods and services are rising over time. As prices increase, the same amount of money buys fewer things, reducing purchasing power. Moderate inflation is normal in a growing economy, but high inflation can make everyday expenses more costly and pressure business profits. Because it affects consumers, companies, and spending behavior, inflation is one of the most important macroeconomic factors. So, what about the effects on stock market? Inflation measures how quickly prices rise across the economy. Low and stable inflation is generally healthy because it supports spending, business growth, and economic stability. However, when inflation rises too quickly, purchasing power falls. Consumers spend less. Company sales may weaken, and stock markets can face pressure. Because it influences spending, profits, and economic growth, inflation is a key macroeconomic factor for investors. Next, GDP growth. GDP growth measures how quickly a country's economy is expanding by tracking the value of goods and services produced over time. Strong GDP growth usually signals rising consumer spending, business activity, employment, and company profits. Weak GDP growth can indicate slower economic activity and reduced earnings, because it reflects the overall health and direction of the economy. So, what is the effects of GDP growth on stock market? GDP growth shows whether an economy is expanding or slowing down. Strong GDP growth often leads to higher consumer spending. stronger business activity, rising company profits, and a healthier stock market. Weak GDP growth can reduce spending, slow business activity, lower earnings, and pressure stock prices. Because it reflects the overall direction and strength of the economy, GDP growth is one of the most important macroeconomic factors for investors. Next up, employment rate. Employment measures the health of the job market and how many people are working and earning income. Strong employment means more people have jobs, which support spending, business growth, and economic activity. Weak employment or high unemployment can reduce income, lower consumer spending, and slow the economy. Because jobs directly affect household finances and business demand, employment is a key macroeconomic factor for investors. So, what are the effects of employment rate? Employment reflects the strength of the job market and the ability of people to earn income. Strong employment means more people have jobs, leading to higher incomes, increased spending, stronger business sales, and a healthier stock market. Weak employment results in lower incomes, reduced spending, slower business activity, and pressure on company profits. Because jobs drive consumer spending and economic growth, employment is a key macroeconomic factor for investors. Next, consumer spending. Consumer spending is the money people spend on goods and services, such as food, clothing, travel, entertainment, and everyday purchases. Because consumer spending makes up a large part of economic activity, it plays a major role in driving business sales and company profits. Strong consumer spending often supports economic growth, while weaker spending can slow business activity. As a result, consumer spending is a key macroeconomic factor for investors. What about consumer spending effects on stock market? Consumer spending is one of the biggest drivers of economic growth. When people spend more, businesses generate higher sales, company profits increase, and stock markets often benefit. When consumers spend less, business revenue may decline, profits can fall, and economic growth may slow. Because consumer spending influences business performance, employment, and investor confidence, it is one of the most important macroeconomic factors for investors. Now, let's look at exports and imports. Trade refers to the exchange of goods and services between countries. Exports are products and services a country sells to other nations, while imports are those it buys from them. Strong trade can support economic growth, business activity, and job creation. However, trade disputes, tariffs, or imbalances can create challenges for businesses and economies. Because trade affects growth, employment, and corporate earnings, it is an important macroeconomic factor for investors. The effects of them? Trade affects how countries exchange goods and services with the rest of the world. Strong exports can boost production, create jobs, increase incomes, and support economic growth, which may benefit the stock market. Weak exports can reduce demand, slow business activity, lower incomes, and pressure company profits. Because trade influences economic growth, employment, and corporate earnings, it is an important macroeconomic factor for investors. Next up, oil and commodity prices. Oil and commodity prices measure the cost of important raw materials used throughout the economy, such as energy, metals, and agricultural products. These prices affect transportation, manufacturing, and business operating costs. Rising prices can increase expenses and reduce company profits, while falling prices can lower costs and support growth, because they influence inflation, business performance, and economic activity. What's the effect on stock market then? Oil and commodity prices affect the cost of energy, transportation, raw materials, and production across the economy. When prices rise, business costs often increase, profits may fall, and stock markets can face pressure. When prices fall, transportation and production become cheaper. Company profits may improve, and stock markets may benefit. Because they influence inflation, business costs, and economic growth, oil and commodity prices are an important macroeconomic factor for investors. And last, we have government and geopolitical events. Government and geopolitical events include policies, elections, regulations, trade agreements, conflicts, and major global developments that can affect the economy and financial markets. These events can create opportunities for some industries while creating risks for others. because they can influence business activity, investor confidence, trade, and economic growth. Government and geopolitical events are an important macroeconomic factor that investors closely monitor. And the effects of them? It can create either opportunities or risks for the economy and financial markets. Supportive policies, incentives, and investments can help industries grow, boost company profits, and lift stock prices. On the other hand, wars, trade conflicts, political uncertainty, or global disruptions can slow business activity, reduce profits, and pressure markets. Because these events can quickly affect investor confidence and economic growth. Now, let's take a look at real-life settings with it. Next example. Back in 2025, Trump announced tariff to all countries, causing global panic sell-off in the stock market during March 2025 to drop an approx 20%. And last example, recent war movement made by Trump. Back in March 2026, another global panic sell-off happened again, causing the S&P/Y to drop approx 10%. So, the takeaway is that we can see how macroeconomies play a big factor in the stock market, from interest rates to geopolitical tension. And to find out where you can get the details of them, I have placed every single important link in the YouTube description. As always, if you find my investing insights or tips useful, a like and subscribe would be greatly appreciated from me to you. And always remember to let compounding do the work for you. See you next time. Stay safe.